Hey, what up? This one we're going to do a little bit different than the last one. So I'm going to put up some YouTube videos. And I'm going to work on my business while I do that. Okay, so how do I get to my subscription? What is this? What is the finance stuff? Hmm. Let's see. What do I want to watch? Let's go out of subscription. Hey, use different. Here we go. Bigger challenge. The challenge of that. Use the collaboration courses. Sam. Oh, cool. Interact market the map. So, oh, that's right. 1:30 10 a.m. So he plans on weighing it. Okay. We already know that Elon Musk bought Twitter and now he's outing all of the Twitter shenanigans that were happening before so that it can be more, I guess, open lines of communication. So that's how much pain for the housing job market lies ahead in 2020. Yeah, let's see.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart. Thanks for joining us for part 2 of my recent conversation over Twitter Spaces with Mike Mish Shedlock. If you haven't yet watched part 1 of this discussion with Mish, in which we dig deep into last week's bonanza of news and data releases regarding Fed policy and the housing and jobs markets, and what that likely means for asset prices next year, head over to our channel at youtube.com/Wealthion and watch it there first. Okay, let's get started watching part 2 of my recent discussion with Mike Mish Shedlock. Real quick, why don't we just wrap up the jobs part, because we didn't quite get to the part that I was hoping to get to, which is
Okay.
I have been for a long time ringing the warning bell that I believe that a lot of layoffs are coming, that this recession is going to be moderate to severe. And there's a whole bunch of reasons why I think that companies will be jettisoning employees as they just try to stay afloat, right? And you have said, well, I don't want to put words in your mouth, and maybe after just hearing what you were talking about with the unemployment rate, maybe it's a semantic difference, but I think what you're saying is hey, the unemployment situation might not change as much as people are worried about.
What's up, you guys? It's Graham.
In terms of just people losing their jobs and having trouble finding work, what's your gut telling you it's going to be like?
That's going to be reasonably strong. We are going to see corporate buyouts. We are going to see, and I talked about this a little bit. There's 22 million people of retirement age, and 10 million of those people can retire. And the other reason why the unemployment rate can stay high is someone's working 2 jobs now, right? And they lose one of them. They're still employed, right? But a job got lost. So, all of those things can keep the production and non-supervisory work week was like 33 and a half hours. So that's like the retail workers, whatever, and then they separate out manufacturing from that. So, that's the kind of thing, so we can lose a lot of jobs. And the other thing I noticed, and I'll go over it every Friday, or excuse me, the first Friday of every month. I put together a pretty detailed job report, and something that I've been tracking for like 8 months now is the number of jobs reportedly keep going up. If you actually look at employment, it's down from 8 months ago, and full-time jobs are down like a million. But everyone's out. Oh, look how strong the economy is. Because of jobs. They're looking at the wrong thing. Yeah, they need to be looking at employment, and it's already weakening pretty severely. So when I say that I'm looking.
I'm just curious. Don't we, if we've spent any amount of time researching unemployment, we know that the unemployment numbers are flawed. So maybe this guy's audience are people who don't know that the unemployment numbers have been skewed to look favorable to the current administration forever. So if you don't know that, then you should probably spend some of your time researching instead of watching TV. Just saying. Let's see what else.
Looking at numbers that Paul Krugman are saying this is going to be really bad. Do we really? And this is data that that comes out after the GDP report. Okay, personal income. The consensus was plus 0.4%. The actual is plus 0.7%.
I guess I don't understand why these people are like talking about 0%. The difference between 0.4% and 0.7%. Oh, you mean 0.4 and 0.7. I don't understand. Who cares? Can't we just get a realistic expectation of things that we're facing so that we can properly prepare for them and that we can properly compensate for our families so that we don't get screwed? That'd be good. How do we do that? Mike, tell us. Tell us something good.
And then you look at personal consumption expenditures shot up to 0.8 tenths of a percent. And of course, if the price index which it was 0.3%, you got a 0.5% increase in real personal consumption expenditures. And at a time when the core is also down or only up 2.2%. So my gosh, what is this going to do to the GDP now estimate? And you go look, and it plunged. It plunged, and their personal spending estimate plunged by more than a point. So what really happened here? And this wasn't the ISM report. It just seems associated with that. Rather, what happened was, and this is actually goes back to a surprise I had at the end of the last quarter when all of a sudden all the data looks absolutely terrible to me, and the GDP now forecast surged, and by the way, a tip of the hat to Pat Higgins at the Atlanta Fed. He actually nailed the report, and I got into a discussion with him about that, and what it was import export data. The imports plunged, exports rose, um, and it was that drove up their estimate of spending. Well, yesterday, and I hadn't even didn't even look too much at the report, but we had the reverse of that. If you look at the international trades in goods and services, guess what? Imports rose 0.9%. Exports shrunk 2.6%. Ding, 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 ding. That's what happened to the GDP Now report today. Consumer spending is taking a big hit. Whereas before, it wasn't really that we had strong consumer spending, but rather that exports were surging, mainly a couple of things, military equipment to Ukraine, government spending, and grains and U.S. energy exports. We were exporting a lot of LNG, liquid natural gas, to Europe. So that explains the surge in GDP at the end of third quarter, and apparently that reversed yesterday. And I didn't look at this report yesterday. I looked at it today when I was trying to figure out what happened, to the GDP Now forecast, and that's it.
Yeah, and so military arms and energy aside, not that those aren't a lot of money being spent right now, but the drop in exports is indicative of what we might expect given these current macro condition, where the rest of the world is not.
Yes, very slow weakening economy.
Exactly,
yeah.
where the ex-US economies are doing even worse than us, right? And so, yeah, we're seeing that demand fall off here. Okay, well, I can't wait to read that when it comes out. Folks, I'm going to give you guys one last chance here. Actually, I see these little check marks, and maybe we do have 2 volunteers here. Hopefully that's the case. Hopefully these aren't just like Twitter verified people. Lance, I'm going to bring you in, and hopefully you are indeed volunteering to be a speaker here. If not, you can just beg off, but I'm going to make you a speaker here. And if you have a question, ask away. And while we're waiting for it, let's see, invite to speak. No, maybe these are just verified Twitter links, because it doesn't seem to be letting me. Oh, there we go. There we go. All right. So Lance, if that indeed is you, looking to raise your hand here, turn the mute off and ask away.
Yeah, I didn't know I was going to get pulled in, but if anybody has any housing questions, be happy to respond with what I'm seeing and what I'm hearing.
Well, what market are you in, Lance?
I'm in the Cincinnati market, but I cover most of the markets. I spent a couple years at Realtor.com before coming to Fortune, and I talk to the different groups that are building different forecast models and have a good idea of some of the proprietary stuff that's out there, and then plus a lot of the public stuff too.
Okay. Well, real quick, tell us what you're seeing.
What's the proprietary stuff?
Well, a lot of the proprietary stuff would be like the stuff like you would see at maybe like John Burns Real Estate Consulting, Zillman and Associates, Zonda, and you kind of got to shake them a little bit to get them to say it publicly. But they've had a lot of interesting stuff, and they were the groups that actually went bearish earlier on. And I'm not talking like September; they were like April. And still kind of figuring it out in March. So it was kind of interesting to see their stuff. And then Moody's Analytics, Mark Zandi's a lot more willing to, provide more of his data. So I'm able to share more of that publicly. But he's not even more on the bearish side. At this point, he's kind of more in the middle. And he's at like a 10% peak to trough drop nationally, with that just ranging so much across the nation, from 3% decline in Chicago to like 18, 20 in like Phoenix and Nashville.
Okay. What do you have for Austin? Just out of curiosity.
Austin, usually, depending on the group, there are a lot of times between like 15 to 30.
Wow.
Yeah. According to the Zillow Value Index, and this is something that's looking more at the middle of the market and it's less noisy. Zillow already has Austin down 10, which is the most in the country.
So Austin's down 10% from a year ago?
10% and like 4 months.
Okay.
Yeah, but keep in mind that's a market that went up 70%.
Right.
Yeah,
Right.
yeah.
That's interesting because I want to say that the numbers that I was looking at only like a month ago were showing that the Bay Area was one of the very first markets, might even been the first market to go negative on a year-over-year basis. So it seems like Austin is catching up fast.
Yeah, catching up fast, and high-end real estate is always more rate sensitive. And San Francisco just has so much on the high-end side. And also, San Francisco tech, and tech's rate sensitive. And then, so many of the buyers there are dependent on their stocks, and that's all very rate sensitive. So the whole Bay Area is just a very rate sensitive market. And if you actually go back and look at 2018, when we had mortgage rates move up from close to 5 for a little bit, San Jose actually went negative year over year, very, very briefly.
Okay. Well, where would you, given the data that you're looking at, because it seems like you pull in data from a lot of different sources, Lance, where would you put your outlook on the market versus, say, like a Mark Zandi, who you said is sort of trying to chart a middle course?
Yeah, I'm not quite sure. I think a lot of it's depend. Let me say this. One thing that I think is interesting is looking at what are the different assumptions that get different groups to their forecast. And for Zandi, he's at 10% peak to trough national decline, and we're already at 2.2 according to the Case-Shiller that came out this week. But if we have a recession and unemployment gets up to 6, then he has it from 15 to 20% nationally. And if you look at the John Burns Real Estate Consulting, which they finally made public this week, they're 20 to 22%, but that's if recession, and all of next year rates kind of hover a little bit above 6%. So I kind of like to know the assumptions, because as we kind of start to see how these assumptions play out, how inflation plays out, is it going to go away quicker and maybe the Fed pulls back sooner? Or is it going to be stickier and longer rates for longer? I really like to look at these assumptions to kind of help to, get a little bit of a guide, for how to read the data.
What do you have? Let's say the 30-year goes to 5%. Did you have an estimate for that?
That's tough. That's a tough number, because at 5% on these prices, affordability is stretched, right? At 7%, we're just like, that's so pressurized, it goes to a place that's even way past like 05, 06. Where we've come to today at like 6.2, 6.3, that's very pressurized. But if you move down to 5, a lot more people not only feel potentially more confident, but millions of people actually regain eligibility, because right now a lot of people have just locked out. The quick move up on rates at these prices almost acts like a tightening of lending standards, because so many people actually lost their eligibility.
Right.
They don't even have a choice. They just can't get the mortgage at the price point they would be looking for. So if you move down to 5%, a lot of people regain eligibility. But then it goes to a question that Ali Wolf, chief economist at Zonda, just tweeted out. Are you more in the camp of, you think there's just a tremendous amount of pent-up demand, these people who are on the sidelines, whether by choice or because they lost their eligibility? Or do you think that during COVID, during this boom, there was this huge pull ahead of demand, right? Like pulling all of this demand forward. And that's an interesting question, and it's I don't have a great answer for it.
Well, let me.
I will.
Go ahead, Dennis. Finish.
I talked to some of the economists recently at the San Francisco Fed who did that report that found that 60% of home price growth during the pandemic was because of the pandemic's increase, or the increase in space that happened during the pandemic. And they're not just looking at the migration that happened around the country. They're also talking about increase in just overall space. And how they were able to do that analysis is they looked at cities with similar level amounts of Well, so in Denver, there is more workers can work from home, and in Utah too, versus Houston, right? And those types of markets, the Utahs and the Denvers, the places where you had even higher percentages of people who could work remote, you got even more appreciation. So it wasn't just people moving across markets, it was just the actual increase in total work from home and that increase in for space. And so where I'm going at with this is a lot of that demand wasn't necessarily fulfilled, right? For people to be able to buy during COVID, they had to pay a premium. They had to pay more, and that's what drove up the appreciation, more demand than there was actual supply. And so it's a question now of, does some of that demand just kind of disappear, right? There was a boom and there was this FOMO and it kind of disappears. Was some of it just kind of pulled ahead? Or is there this lasting increase in demand for housing that was created by this move into a more remote world and less of a, we're going into the office all the time?
Yeah.
How does there's a one more question here, Lance. There's almost a near record number of units under construction. Are those units in places where the inventory is needed, where it's not needed? Do we have too much supply coming on here now, or not enough still?
Yeah. So I'll defer to some comments made last week by Ivy Zellman in a podcast. She had said that there is a lot of this supply out here, and of course it's more in the south and west in the markets where there's more building. It sounds like her view is most of the price pressures or the downward pressure on price that could come from that new supply is going to happen in the first half of 2013. It's already happened, right?
Like 2023, I hope.
Yes, it's already happened, and then into the first half of 2023. But according to her comments in the podcast, and I would need to track that down in terms of who she talked to, it would be less of an issue in the second half of next year. Like builders are kind of already making the moves now, and then through then.
So that's when the supply comes on between the additional increase in supply. All the stuff that's under construction will be finished, mostly finished by the first half, or am I just hypothesizing?
I'm not quite sure how it all crumbles out, but in terms of it, when it's going to put more of the downward pressure and when builders are more worried about moving it, according to her comments, was we're already in that phase and then through the first half of next year.
Right. And we're already hearing all sorts of stories about, builder incentives and stuff like that they're trying to dangle out there.
And this week, John Burns Real Estate Consulting said that some of the builders are actually going back to people who are already on contract and giving them incentives because they don't want to lose them, because so many people are canceling their. The can rates moving.
Do we have the current cancellation rate? What is it?
John Burns Real Estate Consulting, their number they tracked, I think it was really high for October, because that's when we got the 7% mortgage rates. It might have been 20, 25. I don't want to be quoted on that.
The number that I saw yesterday, but it was like really stale, was 26% in August. But these at least that's what I recall. And so okay, what is it now? So I don't know, and don't quote me on that. 26 for August. That's just what I remember seeing, which might be wrong.
All right, Lance. Well, look, first off, thanks for sharing so much of this with us. And other folks, if you have a question you would like to ask, please raise your hand. We'll pull you in here. Before we let you go, though, Lance, just a high-level question for you. I don't know if you were listening to the first part of this before we got kicked off by the technical issues we've been having here on this space. But Mike and I were talking about just the impact on housing prices alone from the increase in mortgage rates over the past, say, 15 months. They've more or less more than doubled, right? and given the mathematical relationship between mortgage rates and home prices, you would expect that mathematically we would need to have a decline larger than what we've seen so far in the markets. And then, of course, there's a whole bunch of other factors we've talked about here: recession risk, more inventory hitting the market, et cetera. But I'm curious, like just taking that first part about how much you think housing prices should come down, just based upon the increase in rates alone that we've seen so far. How much further potentially do you think we may have left to go from that alone? Well, I don't know. Did we lose you, Lance? Mike, can you hear me?
I can hear you. Yep.
Okay. Well, I think we might have lost Lance there somehow.
Okay.
All right. Well, look, actually great that Lance was able to contribute when he could. He had some wonderful perspective and insight to offer there. Looks like nobody else has been a brave soul to raise their hands here yet. So maybe we start landing this plane, Mike. So in wrapping up, just because I promised folks I would ask, you apparently are a bit of a karaoke guy. I am a pub trivia guy, and actually, as soon as we finish up here, my daughter and I are going to go. It's Thursday nights. That's our night. We have a dad-daughter date. Go play trivia at a local pub downtown. You were just at one of your karaoke haunts. I'm curious, what were some of your go-to songs? And of course, Murphy's Law, now that I'm wrapping up in this last question, we have a couple of people raising their hands. So why don't you answer the question quickly, Mike, and then we'll maybe pull in one or two last questions here.
Okay. I do Johnny Be Good by Chuck Berry. I do You've Lost That Lovin' Feeling. I do both the high and the low parts for the Righteous
That is
Brothers.
impressive, I got to say, my friend.
Well, that's actually not as high as you think it is. I can't hit the highs of Roy Orbison and Only the Lonely, by the way. So I can do Teenager in Love. That's actually a fairly high song by Dion and the Belmonts. Yeah. I do Johnny Cash, Folsom Prison Blues, and Ring of Fire. And all of those that I mentioned so far are ones that I know cold, so I can take the mic, wander around the room, and put on a little bit of an entertainment act. Brown Eyed Girl is another one. I do a couple of Beatles songs. I can do about 60 or 70 songs, actually. And there's maybe a dozen that I know stone cold, where I can, wander around the room and entertain and sing to people and get down on my knees for you.
Well, folks, yes, this is
a
hidden talents. Mike's not only just a data hound by day, but he is a lounge spectacular show by night. Showing up in Vegas next week, right, Mike? And so maybe we can all buy tickets and see you at the Mirage.
I did and unfortunately it's removed, but I did Powell Be Good to the tune of Johnny Be Good. But the folks that own the copyright to that made me take it down. Unfortunately, it was a really funny presentation. I had this. It was called actually Bubbles Be Good, and I had this bubble blowing machine, and I had someone, one of my friends who actually looks like Ben Bernanke there, and someone dressed up like Janet Yellen with a white wig, and it was really funny, but unfortunately I can't point people to it because they made me take it down for copyright.
That is hysterical. You really do put on a spectacular show, it sounds like. So, Mike, I'd love it if you put the lyrics to Bubbles Be Good up on your website at some point. I'd love to read it. All right.
I might be able to get you a private copy. I just can't post it.
All right. Well, do that, and yeah, next time we're on live, I'll give the firsthand reaction video to that. All right. Well, let's bring in Vic here. Vic Soyan. Hopefully, I'm pronouncing that last name correctly. He's our first brave soul here to actually raise his hand. So, Vic, I am granting you speaker access here. It'll connect to your mic, and just turn your mic off or turn your mic on, so that we can actually hear you ask your question live.
Hi, I can Can anyone hear me?
Yes, we can hear you, Vic.
Yes, we can.
Yeah.
Go ahead.
Hiya. Quick question. Yesterday I watched, actually day before yesterday, I watched Powell's conference.
Yeah.
Personally, I felt he was very low energy. He didn't have the aggression. He was very passive, and I think he didn't want to fight the market. Now, looking at the 2 years, 10 years, which is about 72 basis points inverted, and 10-year 3 months, which is around 80 points inverted. Do you think we could be looking at rate cuts in March, or the bond market is thinking maybe recession is much closer than maybe previously thought? Because obviously,
I think
yeah,
go ahead.
yeah, because obviously this is quite because I was looking at the history during 19 between 1980s and 1982. The 10-year 2-year was inverted by around 200 to 250 basis point, and at that time the 2 years the 10-year 3 months was inverted around 100 or 120 basis point. Obviously
Mm.
this inversion is getting insane now. The 10-year 3 months, the 10-year 1 year, 10-year 1 month, even even that is getting inverted like crazy, like 40 or 50 basis points it was today when I checked.
Right. The 3 month 30 year is like shocking. I think it's perhaps one of the most inverted in history. And the other thing to put how big this is in perspective is on a percentage basis. Okay, from where we were and where we are now, and just the spread in that basis. I don't think we've ever seen a percentage jump as big as we have. Back in 1982, you had the inversions, but the top end was at all the way up, close to 18%. Or the inversion, one piece of the inversion was up, towards 18%. There's a difference between an inversion, 18 to 14. Now we're talking about we're down here at 4, and we're having inversions almost as massive. That is a very, very strong recession signal. I don't think we've ever seen one stronger. But is the Fed going to cut next year early in March? I don't think unless, and this is what we discussed in the first half, unless there's some sort of a credit event. I don't think there's going to be an unemployment event for the reasons we just discussed. But is there going to be a credit event that would cause the Fed to cut? It'd have to be a pretty nasty one. More than likely, they would pause, cut a half or something. Powell is very, very fearful. You can see it. You can see all the Fed governors. They're very afraid of reigniting an inflation bubble. Now, that's just the way these guys think. I think their thinking is convoluted in many areas, but they're the ones making the calls, and I think they intend to see this thing through and hold rates higher longer. I don't think ultimately that they do that, but talking about a cut in the first half of the quarter, for the first or second quarter of next year, if they do what Adam said in the first session, the market's not really going to like it, because that's something really, really bad is happening if they're cutting.
Great.
Yeah, because the strange thing is, yesterday means I have been watching Powell every month with the FOMC. Before, he never said that we don't want to hike so much that we have to cut because we don't want to cut. This is never he said. What he said previously was, we if we over tighten, we can support the economy. That's his exact words. But
Mm-hmm.
yesterday, day before yesterday, he said, oh, we don't want to over tighten because we don't want to cut. as quick.
I don't know about you guys, but this is interesting. I'm sure that these guys know a lot about what they're doing and stuff. It's just really difficult to make big decisions based on little percentages of smaller information. So I'm not feeling it today. Let's see what else we got. How bad cash burn is at my housing startup, or about house hacks. I don't want house hacks. See what this. How to get rich.
What's up, Graham? It's Guys here. So I've got some good news and some bad news. The bad news is that more than half of Americans are already behind in their retirement savings. Elon Musk is bracing for a painful recession throughout.
None of that should be a surprise to any of us. That's been going on forever. We suck at saving money. We'd rather spend it. I don't know. I would do.
2023, and the housing market could drop by as much as 20%. However, the good news is that right now could be the best entry point for stocks in the last 15 years if you want to make as much money as possible. Or basically, according to JP Morgan, if you wish that you could go back in time and invest in 2010, now could be that opportunity. That's why it's so important that we cover exactly what they say is going to happen, which investments are most likely going to make you the most amount of money, and why this one index fund strategy is expected to outperform just about everything else over these next 10 to 20 years. Although before we start, it would help out tremendously if you index funded the like button and subscribed for the YouTube algorithm. It does help out tremendously. I post 3 videos every single week, and as a thank you, here's a video of a mantis shrimp. So thank you guys so much, and also a big thank you to public.com for sponsoring this video, but more on that later. Alright, now I've covered index fund investing before in the past in terms of what it is and why it's so profitable, but for anybody new, it's worth repeating because this encompasses everything that you need to know about making money. Now, for those unfamiliar, an index fund is basically just a big container of stocks that you could buy into for one low price, so that way you get to own a small piece of everything. Like, here's an example that I've used before in the past. Imagine if I owned 1,000 apartment buildings, each one of them was worth $1,000, and I offered to sell you one of them at that cost. That would be the equivalent to buying one stock in one company. But the problem is that you only have one apartment building or one investment, and what happens if it doesn't do very well? Or maybe you just happen to pick the one unlucky building that goes vacant and you lose all of your money. So how do you prevent that? Well, here's the solution. Imagine if I gave you an alternative option where you could give me that exact same $1,000, and instead of buying one building, now you get to own 0.1% of everything that I have. This way you get an overall return of 1,000 buildings, and in a way an index fund is the exact same thing. The advantage of doing this is that index fund investing has outperformed 99% of individual investors over a 20-year period, meaning over 20 years you're going to make more money doing this than buying individual stocks. After all, when you look at the average investor's return from 1993 to 2012, it's horrible. So this is the way you avoid embarrassment over holiday dinners. Plus, doing this is very little work, there's no experience required, and there's an index fund for practically anything you could think of. Like, I kid you not, if you took Vanguard as an example, you have 266 different options that cover everything from large caps, small caps, international, communications, real estate, bonds, growth, dividends, blends of everything. It's insane. So without further ado, these are my top 5.5 favorite index funds of 2023, exactly how much they cost, how much you could expect to make, and how you could get started investing, because not all index funds are created equal, and it's important to discuss the pros and cons of each so that way you could decide which one is best for you. Alright, so coming in at number 5 is one of my all-time favorites, VT Sachs. This is a Vanguard index fund that encompasses the entire US equities market, all in one fund for less than $100. If there's a small, medium, or large cap stock that you could think of, chances are this fund owns a small piece of it. And with those 5 letters, you get exposure to 4,028 different stocks. The benefit of doing this is that if you're looking for one all-around fund that covers everything you could possibly think of, from basic materials to utilities, without complicating yourself with charts, graphs, numbers, and math, This is it. In fact, this fund is almost like the cornerstone of Warren Buffett's approach of never betting against America. And since its inception in 2000, it's returned an average of 7% every single year, and in the last 10 years, it's returned over 12%. However, there is a downside to a fund like this. Like, first, there is a minimum of $3,000. Now, of course, if you want to go around this, you could buy their ETF version, VTI, which is essentially the same thing with no minimum as long as you have enough to buy the piece of the stock, but you can't automatically reinvest like you can with the index fund. So it's a little bit more work on your end if you ever want to add on to this over time, but it's not that big of a deal. Now, the second downside is that there is a 0.04% management fee for VT-SAX and 0.03% for VTI, which is really cheap in the big picture. But if you want to go around this, you could also go with Fidelity's FISROX Total Stock Market Index Fund, which is newer and started in 2018, but has no expense ratio whatsoever. Yes, you heard that right. It's free. These fund managers are doing all of this at the cost of nothing, so use that to your advantage. Although I will say, this is only just the tip of the iceberg, and a few of these other options could wind up doing significantly better. And that would be one of the most popular of all of them, VFIX, otherwise what's known as the S&P 500 Index Fund, which you're probably tired of me talking about, but I'm back to talk about it some more. For those unaware, the S&P 500 is largely considered to be the gold standard of the US equities market because it contains the largest 500 publicly traded companies weighted by market cap. That means the top 20% of companies held within the fund include the likes of Apple, Microsoft, Amazon, Tesla, Google, and Berkshire Hathaway. Wait, what happened to Facebook? Oh, wait, no, never mind. Anyway, the S&P 500 has long been one of the prized indexes because their stocks are curated by an S&P 500 committee who purposely selects companies based on profitability, market capitalization, sector allocation, and liquidity. So this provides a stringent vetting process of due diligence that would be almost impossible for you to do on your own. Now, in terms of its performance, since 2000, it's earned slightly less than the total stock market index fund at 6.93%, but in the last 10 years, it's slightly outperformed with an average annual return of almost 13%. It's also down 17% year to date, which means in hindsight, it's a lot cheaper to buy today than it was a year ago. But of course, not everything is perfect, and as far as one of the downsides, there is a minimum of $3,000 to buy in, just like the last one. So if you're watching this without the $3,000 to invest, you could also look at their ETF equivalent, VOO, which has no minimum, trades like a stock, and is pretty much the same thing. Now second, also like the previous one, there is an expense ratio of 0.04%, meaning this investment is going to cost you $4 for every $10,000 you invest. This is still really cheap, but thanks to friendly competition and the race for a competitive market advantage, Fidelity replicated the exact same thing with a management fee of 0.015% through their FISROX fund, which at that price they may as well just make it free for additional marketing, but you know what, that's none of my business. But in addition to those two options, you may want to consider adding a third one onto the mix, and that would be number 3, an international index fund like VTIX. However, before we go into that, I just want to say sometimes being an investor could feel like riding a roller coaster, and during uncertain times, it's important that you have as much information at your disposal as possible. That's why our sponsor, Public.com, wants to help, because they're an investment platform that helps people be better investors. To start, they're the only investment platform that allows you to invest in a variety of options, from stocks to ETFs to alternative assets and collectibles and more, all in one place, surrounded by a community of like-minded investors. In addition to that, Public also gives you all the information and tools that you need to make informed investment decisions, with options to browse both their desktop version or the app. Plus, they have a premium membership tier where you can unlock advanced data, portfolio management tools, and analyst insights, so that way you're kept up to date on exactly what's going on. Like say, for example, that you want to evaluate a stock in close detail. Public allows you to track unique metrics, like how many vehicles a specific model Tesla has delivered this quarter, Netflix's subscriber growth, or Apple's revenue breakdown per product line. You'll also gain institutional-grade research from Morningstar to hear the pros and cons of the most popular stocks. Public Premium members also get access to extended hours trading to be able to react to after-market hours headlines and news. Not to mention, when you sign up at public.com/Graham and transfer an account from another brokerage, you could get all the way up to $10,000 as a bonus depending on the amount. And if you transfer $20,000 or more, you get to skip the waitlist and get instant access to Public Premium. Check out the additional terms and conditions of the offer by following the link down below in the description to learn more. Thank you guys so much, and now let's get back to the video. Alright, now in terms of index funds, so far we've really only covered the US equities market, but when you really get into it, that's just the tip of the iceberg. So an international index fund covers everything else outside of it, from emerging markets, Europe, the Pacific, the Middle East, and North America. Plus, some of their largest holdings are the companies that we use day to day, like Nestle, Semiconductors, Samsung, Toyota, and so much more. The advantage here is that as other countries grow and develop, their stock prices increase and your investments do better, but there's a bit of a catch. Over the last 10 years, international index funds have remained fairly flat, and throughout the last 2 decades, the United States market has outperformed just about everything else out there. Although just keep in mind that that isn't always guaranteed to happen. Throughout history, there have been multiple times that international markets have outperformed the United States, like throughout most of the 1980s and 2000s, and there's certainly a chance that that could happen again, especially if we could be seeing a 2023 recession. Now, in this case, something like VT Sachs has only returned 3.2% since its inception in 2010, which sure, is very disappointing when you compare that to something like the S&P 500, but it'll pay you a dividend of roughly 3.64%, so that means for every $10,000 you invest, you'll get $364 in passive income. Of course, just like the others, Vanguard does have a $3,000 minimum, and because international stocks take a little bit more to facilitate, there is a higher expense ratio of 0.11%. But there's also their ETF version, VIXIS, with a 0.07% expense ratio, and you could buy it anywhere that you could buy stocks, like with our sponsor, public.com/Graham. Of course, Charles Schwab also has their ETF version, SCHIF, with the 0.06% expense ratio, or Fidelity with FIPSITIX, who charges 0.035%. So just Google my preferred broker international ETF, and voila, like magic, it'll appear. There you go. Now, when it comes to myself, I personally see this as a bit of a hedge against my portfolio, since most likely the US is not always going to be in the lead all the time, especially as other countries ramp up production. Plus, even if it does underperform relative to everything else, at least I'm getting paid a higher dividend in the meantime. That's why I keep about 15 to 20% of my index fund portfolio in this, and then the rest is spread throughout a few of these other options, including fourth, a growth index fund like VIGAX. Like I mentioned earlier, there's an index fund for anything that you could think of, and even though we could focus on dividends, small caps, or technology, this one focuses on one aspect that could do really well. This works by taking the US market, filtering out everything that does not have high growth potential, filtering out again any smaller companies that were only surviving because of endless money stimulus printing, and voila, you have a growth fund that isolates the likes of Apple, Microsoft, Amazon, Home Depot, Google, Visa, MasterCard, and more. As of now, it contains a mix of 249 companies geared towards the businesses that will either do really well or really bad. And since its inception, it's annualized an almost 7% return after already going down 30% from the peak. In other words, this one is very high risk, high reward. So if you would imagine a seesaw, this would be near the edge with the most to gain or lose if you aren't prepared. For example, from 1997 through 2013, growth stocks like this did the worst out of just about every category, and the winner during that time frame was emerging markets. That just means that you cannot build a portfolio off of what did best in the past, especially in the short term. So it's essential that you do not put all of your eggs in one basket, unless you want to post screenshots on Wall Street bets for your wife's boyfriend. As far as this fund is concerned, it shouldn't come as a surprise that there is a $3,000 minimum, as well as a 0.05% expense ratio for managing the fund. But you could also go for the similar ETF VUG, which has a slightly lower expense ratio of 0.04%, and all of that could be yours for $225. Although if you're truly lazy and you don't want to have to worry about balancing portfolios, managing risk, and buying 15% of that, then you could take the easy way with this one. And that would be with number 5, a global stock market index fund. This is what happens when you combine everything that I've just talked about, blend them together, add in a pinch of emerging markets and a hint of growth, and then all of a sudden you get something like VT Wax. This gives you exposure throughout the entire world.
Hi guys, I just had some recruiting for our team, so I should tell you what's happening. I'm playing this market crash stuff, and he says a lot of the same stuff a lot of times. Buy, keep investing, invest when it's up, invest when it's down. Never stop investing in index funds, because index funds are the most diversified and least risky way to invest in the stock market. The dilemma with that is you're still in the stock market. If you appreciate the stock market and you want to be part of it, do it. Personally, I don't do that, but I can see the value in doing it, so I can understand it. But I had someone message me about being part of our media company, so I had to take a second, find my brand statement. I also want to put these stats on my little paper here so I can reference it more quickly. Key stats. Market size. Revenue per month. Starting cost. Gross margin. And build. Growth. Business model. Time investment. Market size. 1.7 trillion. 6. Revenue on 30,000. Starting 5,000. Yeah. Gross margin 60%. So in days. Growth quarter. Would change some of these things. Subscriptions. Both. Like growth, word of mouth. You actually use the social media platforms, algorithms to make you grow. But whatever.
World with 9,548 stocks and a balanced combination of large cap growth and value companies. This means that you'll get some technology along with dividend-paying oil companies along with international companies. Now, even though this fund was just started, since 2019, it's returned an average of 7% a year. And if you're buying today, it's 20% cheaper than it would have been at the beginning of the year. So how's that for a holiday discount? On top of that, you'll also be getting a dividend of 2.4% that you could then use to be buying even more of it to get even more dividends. Of course, no surprise, since you do get the convenience of having everything you need blended together, you will pay a higher management fee of 0.1%, which isn't terrible, but if you go to the ETF version VT, that only has a 0.07% fee. And there you go, I just saved you $3 for every $10,000 that you invest, so just don't spend it on Starbucks. Now just remember, with an index fund, you're able to set up recurring investments to dollar cost average into the markets, you're able to buy in with a precise dollar amount down to the penny, and everyone buys in at the same price at the end of each trading day. But that usually comes at the cost of a higher minimum investment with a fund that generally cannot be transferred from broker to broker without paying a hefty fee. But on the other hand, an ETF trades just like a stock. There are zero minimums as long as you could just afford the price of a share, and you could transfer them between brokerages in the event you want to switch. To be honest, it's probably not going to make that big of a difference for almost all of you watching, but it's worth covering so that way you're not scratching your head wondering, why does Graham move his hands so much? And finally, as an honorable mention, we have to talk about something that's done so horribly that it actually might make a good safety net moving forward, and that would be a bond market index fund like Vibitalix. Here's the thing, when it comes to investing, there's a strategy called the 60-40 portfolio that says you hold 60% equities like stocks and 40% bonds. The goal is that this provides the ultimate stability, because when stocks go down, bonds hold their value and pay a dividend, and when stocks go up, then bonds do their thing thing by normalizing your returns. However, in 2020, something interesting happened. Bond values plummeted because the Federal Reserve lowered interest rates to zero while printing a lot of money. And because of that, the 60-40 portfolio is on track for its worst year since 1936. This is, by all accounts, probably an anomaly, and that leaves the door open for a lot of people to scoop up bonds for the cheap. And that's exactly what JP Morgan believes is going to yield a 7.2% return over the next 10 to 15 years. That's why something like Vipitalix could be a good padding for your portfolio with a 4.4% yield that since inception has delivered a return of just over 3%. And for a small part of your portfolio, this could end up doing pretty well with a 0.05% expense ratio. Now, as far as what I do a combination of everything. I personally hold most of my money in US equities, but I also have 20% spread throughout international index funds and another 20% throughout treasuries, which accomplishes almost the same thing as a bond minus the price volatility. To me, this gives a ton of diversification, some risk, and a lot of stability while maximizing the returns that I'm able to make. It's probably not perfect, and hindsight is always going to be 2020, but that's what I'm doing. And with a few funds, you'll be well on your way to outperforming the vast majority of investors out there by keeping it simple and thinking long term. So with that said, you guys, thank you so much for watching. As always, feel free to add me on Instagram, and don't forget our sponsor public.com is a bonus down below in the description for anyone who wants to claim it. Enjoy. Thank you so much, and until next time.
That was Graham Stephan, and I think he's really good. Like, he's awesome. I don't have any problems with him. Let's see what else we got. Oh, this will be fun. 2 years ago. Mostly I'm interested to see if I'm going to get in trouble for sharing these guys' stuff, or if I'm going to get hit with the trademark that I can't share them while I'm live or whatever. I'm just experimenting, and whoever watches this, you're the bomb for watching it at all. This is brand new to me. So let's see what we can do. 1:30. Honestly, I'm going to take a break. Just kick my butt. I can do it. I can go home prayer. Alright, guys. I'll be back. See you in a minute. Not 1 minute exactly. See you in a little while. 2 o'clock.